Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500, but most importantly, the VIX, the volatility index of the S&P 500 that we've seen rise since 2017 here, right? Steadily over and over again, we've been in a period of rising volatility. The last two secular periods where we've seen this type of action on the VIX has been in the late 90s, here since 1994, all the way to 2002 and 2007 to 2008. So the question is, what does it mean for the market? So of course, in the vast majority of cases, as the volatility is rising, you have the stock market falling. That has been proven throughout history over and over again. 2011, volatility rising, stock market falling. 2015, stocks falling as volatility rises. During COVID here, volatility spiking, stocks are crashing. And of course, let's not forget 2022, volatility rising and stocks moving down. But now the question is whether this test of the trend line that we're eventually going to see, whether that's going to be a bounce in volatility, which would look something like what we saw in May of 2008, and also what we saw right here in March of 2002 and in August of 2000. If I add the S&P 500 on top of this chart, those were all big tops in the market. August 2000, March 2002, May 2008, and we can argue that this is another bounce of that trend line in around November of 2021, a big market top as well. So should we expect a bounce off this trend line, a break of this trend line that would mark a lot more upside? Those are the questions that we're going to be answering in this video. The idea behind these videos is really to open your mind up to different possibilities in the market. I'm really not trying to force you in a certain direction. Of course, I do have my own opinion on what's going to be happening, but I really want to show you. But what I really want to do in these videos is show you guys a different perspective on the market that perhaps you haven't seen anywhere else. So if you do enjoy this video, don't forget to smash that like button because it really does help out the channel. And of course, subscribe if you are new here. Now, without further ado, let's get right into it. Now, I do want to make a quick reminder so that you guys don't miss this. We've only got a few hours left on the Black Friday discount. That's a 40% discount on our memberships. We never do these types of 40% discounts, so make sure not to miss it. We're really building a service that is ideal for the individual investor. We strive to have the best research possible, always trying to improve on our strategy, trying to make the best calls on the market across different assets, and then of course selecting those assets for the macro environment to maximize the risk reward, have high returns regardless of the macro environment, and of course hedge against the risks, right? Whether that's inflationary, a global financial crisis, geopolitical risks, these are things that we're taking into account in our strategy and funneling it down into a model portfolio with what we believe is the ideal allocation for those assets. And that's all presented in a concise, clear, and actionable way. So if that's a service that you think you'd be interested in, make sure not to miss the Black Friday deal. Now, let's first take a step back and look at the bigger picture. Does rising volatility always mean falling stocks? So we can answer the question, if we see a bounce in volatility here, well, we'd see stocks crash, right? And most of the time, that is the case, right? You can see, as I said at the beginning of the video, as volatility rises, stocks are falling. Most periods of rising volatility are associated with falling stocks. But it's not always the case. An example of that is the late 90s, between 1994 and around 2000. Look at this. We had the volatility rise steadily throughout that period, while stocks were also moving higher over that period. And in fact, you can argue that between around 1996 and 2000, you had the VIX basically stay in a range between 18 and 30, which is a range that we've been in more recently right here. And throughout those 4 years, stocks went up massively. They went on a massive bullish run. So that's the first piece of information that I think is worth highlighting. But ultimately, what this means, higher volatility and higher stocks, that's an unhealthy bull run. That typically means you're heading towards a big top. And that applies for the weekly time frames like on this chart and the shorter time frames. If you see volatility rise with stocks rising, that's a very, very ominous signal for for stocks. And I can quickly show you, for example, right here in 2007, look at what was happening to volatility as the market was moving higher to that big December top right there. All-time high in around October of 2007, and leading up to that high, you could see the volatility make higher highs. So that is unhealthy behavior. That was your selling opportunity right there. So the question you're probably asking yourself, okay, that's very nice. Rising volatility with rising stocks is not good, and we saw that leading up to the big .com top, but we've had the same thing happen since 2017 right here. Beautiful trend line of rising volatility as stocks have been making higher highs. Is that an unhealthy type of price action? And I'll give you the short answer, and I believe that is not healthy. I believe this is the volatility telling us we're heading closer and closer towards a secular top, similar in magnitude potentially to what we had in 2000 that eventually led to a 10-year period of underperformance in the market all the way to 2009. A very devastating period for investors. And that top, when it comes, if it has already come, and we're going to talk about that in just a second, but that's going to mark the top of the secular bull run. Now, a lot of people assume that we've seen the top of the secular bull run that we've had since 2009, and that it's a done deal, that, you know, the bull run's over. But I think that couldn't be farther from the truth. I think those people have a very big bearish bias, because if you look at the price here, you look at the price, we're making higher highs, we're making higher lows, and that trend has not changed. The secular bull run is not done because the trend is still to the upside. Right, we're still making higher highs, we're still making higher lows. I don't believe that the secular bull run is done quite yet, or at least technicals have not shown that we've seen a significant breakdown of that bull run. But when we do come back eventually to that trend line right here, just like we did right here in June 2021, just like we did here in October, in December of 2019, and of October of 2017 right here, all being major tops recently, that is going to be something to watch out for very carefully. Because the day you do get a bounce off this trend line, you're going to be making a major top in the market right here. Let me quickly show you how I come up with this. Now, if we put this trend line accurately, and we capture the lows on this line chart of the VIX very, very accurately. You can see here the 3 lows, 1, 2, 3, makes a trend line. So this is the right trend line on the VIX. You could argue that it won't be until mid-2023 until we reach that trend line, right? If we have some sort of sideways price action like we had between around May 2017 and December 2017, if you have this type of price action leading up to that trend line, well, that is a few months of sideways price action on the VIX. And by the time you hit that trend line, the market could be a lot higher, right? That could leave a lot of time for the market to move potentially back to its all-time high. Now, if that happens and you get a new high on the market, but the VIX is holding that trend line, that would be extremely concerning. That would potentially be telling you you are seeing right there and then a secular top in the market, and that's your exit opportunity. That's the scenario that we are favoring right now. I think we are heading towards a secular top, and that we're going to see a broader period of underperformance after this 2009 to 2021 to this 13, potentially 14-year bull run. But if you see a breakdown of this trend line here, right, and this is something to watch out for, that would mark the beginning of a healthy bull run. Right? You can see that happened in 2003. It happened in 2009 right here. Those were really moments to be entering the market when that uptrend in volatility was broken down, and that was confirming that stocks had a lot more upside. Because this is what a healthy bull run looks like, by the way. Declining volatility and rising stocks, it's telling you that you're in the right direction and that you're not heading towards a major top. We had that throughout the early 90s as well. You had declining volatility and rising stocks. That was a very healthy bull run. So the day you break that trend line is the day you're starting out new healthy bull run, where the VIX is not telling you you're heading towards a secular top. Now, should we expect a breakdown of the price channel now? I don't think so. I do think that we're heading into a recession, and that could be terrible for stocks. And I know that's a pretty consensus opinion right now. I do think that we're heading into a recession, and that can be terrible for stocks. We just don't think that the recession is happening right now, right? And that there's a lot more time for volatility to cool down, come down to the trend line, stocks to rally higher before you eventually do get that big recession, right? If you look at the 10-year minus 3-month yield curve, it's inverted. Right, it is inverted, and that is a recessionary signal. If I put the unemployment rate on top of this chart, you can see it's pretty much the same chart. So we have a lot of space here for unemployment to rise in the next couple of years. But that doesn't mean it's going to happen now. We could still see unemployment rates stay low till mid-2023 before we do get that recession. And I think that's what a lot of people are missing right now. Of course, that's just our opinion. And we made a tweet here with the most anticipated recession ever. You can see the number of professional forecasters at the Fed predicting a recession is skyrocketing. But you can see they've got it wrong many times before. You can see here 1978, they were early. The recession only came in 1990. In 1988, they predicted a recession that only came in 1990 and 1991. So a year or two early here. In 1998, they predicted a recession that only came in 2001, a couple of years early again. In 2006, you can see here recession. Professional forecasters started to really predict a recession in 2006. It only came in 2008. If we zoom in here, in December 2018, recession probabilities were skyrocketing, but the recession only came in 2020. And that's why there's probably a good setup here until we reach this uptrend in volatility that we've seen since 2017. So I hope you guys enjoyed this video. If you did, don't forget to smash the like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.